Good evening, everyone, and thank you for attending tonight's webinar. My name is Caroline Seymour, and I'll be hosting tonight's webinar along with our two owners, Stephen Gokes and Brett Nelson. It's great to see plenty of existing investors tonight on the call, together with new clients looking to learn a little bit more about Natgen and what we do, and specifically about our self-storage development trust, Natgen Investment Trust PR25. The presentation will run for about 20 minutes, allowing for 10 minutes of question time at the end. We aim for this to be interactive also, so if you've got questions along the way, down the bottom of your screen you'll see a little Q&A button, so please type questions in there as you think of them along the way. Tonight's presentation does not constitute financial advice. Before making a decision to invest, you do need to read the information memorandum in full and seek advice from your accountant or financial advisor. The offer is available to wholesale investors only, and I'll hand over now to Brett. Thanks, Brett.
Thank you, Caroline, and thank you to everyone who's taken some time out of their day to join us for our PR25 webinar tonight. It's great to see so many people online. Natgen was founded in 2019 by Stephen and I with the aim to provide investors with consistent monthly income and capital growth through purchasing or constructing commercial property. Our focus has been helping new investors find value in commercial property, as well as helping existing commercial property investors diversify their portfolios with the access to the different asset classes that Natgen offers its investors. On the screen, you can see an example of one of our development trusts, Natgen Development Trust UC22. Down the left-hand corner is the completed building, which is a large-scale self-storage facility which we've built along the M1 that runs between the Brisbane and the Gold Coast, which you can kind of see in the right-hand corner of that screen. This asset has now finished construction. It's currently in its let-up phase. Very similar asset to the PR25 Development Trust we'll be talking about later in today's presentation. Since 2019, Natgen has grown to a touch under $250 million of property under management, made up of 18 different investment trusts. We've purchased almost $50 million of commercial property in the last 12 months. And I'd like to specifically mention this point because for those of you who have been following us for a while, would have noticed that we didn't purchase any freestanding assets in 2023. And I like mentioning this because I think it demonstrates our Natgen investment philosophy of only purchasing property when we believe we can find real value for our investors. We don't just take something into a trust because it's there. We have a very specific strategy for what we buy, and Stephen and our acquisitions team look at hundreds of assets every year to find the 4 or 5 or 6 assets or blocks of land that we decide to purchase. For those of you who don't know much about Natgen, the first product we offer is the Natgen Investment Trust. This is mainly focused on providing regular monthly income to its investors. This is where we target an existing asset, we acquire it, and then we operate it for investors to provide them with steady, ongoing, regular monthly income. And these trusts normally operate for about 5 to 6 years, and we target a distribution rate of around 8%. The second limb of our investment, which we'll be talking about tonight, is the Natgen Development Trust. This is where we simply find a development site, put a development project together and build it with the help of investor funds. And compared to other investment funds in the market, we think that we're pretty unique because our investors actually stand in the shoes of the developer and hopefully earn the development profits based off the equity they put in at the end of the project. With these development trusts, we have 2 different types. There's the short-term and long-term development trusts. The short-term trusts normally run for about 2 years and target a return of about 25%. The long-term development trusts, which is where we find a block of land, build a building, retain it, manage it for a period and pay distributions hopefully for this period, and then sell it after completion, sort of 6 to 7 years down the track. And in these types of trusts, the development profit is actually built into the unit price of the investment once the development is complete, and then realized down the track after we've paid distributions and sold the asset. And the PR25 self-storage development is an example of a long-term development trust, which we'll be talking about tonight. Another thing that's worth noting is through Natgen Property Trusts, investors gain access to three forms of return through us. Firstly, you have the obvious one, which is the monthly distributions, which are made up from the net income generated from the property in that financial year and are physically paid into investors' bank account each month. The second one is the potential, for that property or development project to have a capital gain, and at the end of that investment term, if there is a capital gain, it is returned to the unit holders. And then the third, which is a little bit more complex, are the taxation benefits which investors receive through non-cash deductions. Um, as I mentioned, these are slightly more complex to understand, but essentially, investors who receive a tax deduction for expenses which are not physically paid in cash. And some examples of this, for those of you who may own residential or other commercial properties, will know that the capital works depreciation deduction is an example of a taxation benefit which allows investors to have deferred tax deferred distributions. I'll now hand over to Stephen to continue with the presentation. Thank you, Stephen.
Thanks, Brett, and thanks everyone for joining us. I'm going to talk to you tonight basically about the general property market and how where we are and why we choose the types of investments that we do, and specifically what has led us to the site and the development for our Natgen Development Trust PR25. So just generally in terms of commercial property, this is a chart that we always show in our presentations because it indicates one of the benefits of commercial property over time, and that is basically the purple bars of this chart, which is the fact that income generation is actually very consistent over time. This chart is actually created by MSCI, which is a real estate company which tracks institutional property within Australia and actually globally. So this is the Australian institutional property market. And as you can see, the green bars indicate capital growth or otherwise capital losses at times. And as you can see, even as the cycles come and go in terms of the growth of capital over time, the income is very consistent during both times of increase in capital and also times of decrease. But also you can see it's a very cyclical business in that sense. And also the old adage of in commercial property, time heals all wounds is pretty much correct, because the areas of the green bars is significantly greater than the areas of the green bars at the top is significantly greater than the green bars below the line, which indicates value growth over time. And really, that's two of the three types of return that Brett was talking about earlier. So what we try and do at Natgen, and we do this every day when we're looking for the various investments that we do, is we're looking for mispriced commercial assets, and that involves either mispriced categories of assets or specific assets within those categories. So the areas of opportunity kind of change over time, and we have very specific areas of focus, and we choose those early, and we tell you about them before we go and look for properties in those areas. And basically, you as a Natgen client will pretty much never see something that we haven't been talking about for some time before we actually get it into a trust. So our current opportunity areas for investment trusts are our regional convenience retail, non-CBD office assets, industrial assets with rental reversion opportunities, and specialist assets such as medical facilities. We have examples of all of those within our broader portfolios for various investors in our various trusts. And of course, the last one is development, which we're talking about tonight. So when we choose these areas, we look basically at sociological factors are the main issue to see what's actually happening in the world and where people need to be, because the value of property is all about where people find value being and interconnecting and basically spending time with each other. And a good example of where something has been mispriced relatively recently is when work from home came along, which was part of the COVID shock. Basically, people misunderstood that short-term shock of people working from home basically exclusively was not something that was really sustainable on a sociological basis, because a lot of people want to actually interact with people in their various in their various day-to-day lives. And what we've ended up, of course, is a little bit of a hybrid where people are working more 3 or 4 days a week in offices when they can, and possibly a day or 2 days a week at home. So the consequences on the office market of that, for example, have been much less than was initially expected, and of course that's meant that there's been a difference in how this has caused valuation shifts, and it's actually been much less than we thought. So, but that's for another time. So let me now talk a little bit about how these sociological aspects impact our site. And what we're doing here, because basically the key drivers of self-storage investment and growth are household growth, number of households growing, and also household mobility when people move in and out of houses. And the main growth areas in Brisbane, well, first of all, Southeast Queensland is one of the massive growth areas of Australia, and the main growth area of that is in excuse me, to the southwest of Brisbane. As you can see on the right-hand side in the small map there, our site is at Park Ridge, which is right within that growth zone, which is kind of between Ipswich and the Gold Coast. And this is driven by housing affordability being greater in that area than other areas closer to the coast or indeed inland. So as you can see on the left-hand side, our site is directly opposite a large housing estate of quite substantial size houses on very small allotments, which is one of the things that drives affordability. That whole estate wasn't there a year ago, and it's incredible how quickly this part of the southeast is filling up. Sorry, southeast Queensland to the southwest is actually filling up. And another aspect I wanted to point out to you is population growth nationally. So I was a little bit shocked to find out that in the last 4 years that we've added 2.5 million people to the Australian population. Why is that significant for us? Principally because for each million people that you add to a population, you require this amount of extra space. So in a logistics and storage sense, 4.5 million square meters per every million people. So for 2.5 million, well, you do the math. It's over 10 million square meters of extra logistics and storage space, of which we're building way less than that for some very good reasons. Retail, 800,000 square meters. Office, 800,000 square meters. A bit scarily, you need 420,000 houses and the others there. But the limiting factor is not only what the requirement is, the demand, but the ability to supply these things within a reasonable cost structure is something that's actually pretty limited as well. So basically, that's the basis of the opportunity, is to get into that logistics and storage demand area. So in this case, our self-storage, excuse me, facilities rely on these aspects of high population growth, relative undersupply compared with demand in the area, limited competition due to the size and nature of the facilities that we're building. They are quite big capital intensive buildings. So we're moving from a self-storage industry that was sort of mums and dads driven now to people with access to capital, and really the favorable demographics of this area. So the demographics can really be shown quite starkly by the chart in the middle of this this page, and really this is a heat map of population growth, and the darker the red, the more the population growth, and the dark red on this Southeast Queensland map indicates it's right in the epicenter of where our facility is. And this catchment is one of Australia's top 10 growth areas in 2023-24. So if you look at the right-hand side there in the mauve, the sort of Chambers Flat, Logan Reserve, and Greenbank North Maclean areas, which are right here where Park Ridge is, showed massive growth in population, and that's just going to keep growing over time. On the left, you can see how we do our site analysis in terms of where we're going to get our tenants or our customers from. And the darker purple is the primary trade zone, and the lighter is the secondary trade zone. And this basically equates to either a 10 or 20-minute drive from the facility. So when we overlay that with the population growth areas, we can be assured that there is appropriate demand within the areas that we're dealing with. Also, along with these population growth areas, and really to use as a bit of a check to make sure we're doing the right thing, is we've got a lot of infrastructure growth in these areas too. So here we've just noted a few of them. We've got a major upgrade of expansion of Logan Hospital due to population growth. You've got massive increases in population in the priority development areas of Flagstone and Yarrabilba. And those of you who've been with us for a while would know we've invested in development in Yarrabilba. And basically there's a lot of infrastructure going in this area, which, as I said, we can use as a check to make sure it's the right place to be investing our unit holders' funds as well. So moving along to Natgen Development Trust PR25, I'm just going to put this chart up, not to go through specifically the details of the return profile, but just to show the three phases of the project. So we have about a 12 to 18 month actual construction period where we build the facility, and Brett will go into that a little bit more in the future later in the presentation about how we've done that at both Upper Coomera and Mollendina on the Gold Coast. And then the orange area indicates the let-up period where we deliver a brand new building which is empty, and then we go through the process of getting it to full economic occupancy, which is around the 90% mark. And then from there on, the greys basically indicates the income generation past that time. In terms of timing, this is just a bit of a timeline that indicates that in a slightly different way. So basically, between completing the capital raise in October, we'll settle the site in November. We'll start our contract in around March, April 2026, and have that completed around 12 months after that. There's a few months of revaluation and getting the asset ready, and then the let-up period will commence in June 2027, and nominally take about 2 years for that to happen. And those timeframes are basically dictated by the valuations that we get from independent valuers and other consultants that we use to give us their advice on these types of things. So perhaps one other thing to notice is that we're not the only people that have noticed the self-storage industry. I've personally been invested in it since 1997, and uh, my family assets in self-storage were sold out in 2018, which means we were in it for about 20 years, and it was a very good area to be invested. I was kind of sorry we moved out of it actually, but since then we've been looking for sites to involve our Natgen investors in this area, and we're not the only people that have noticed. There's a lot of institutional money coming from the United States and Asia into this area as well. So you've probably seen some of these headlines as we've gone forward over the last 12 months or so, I should say. And we consider that's going to continue because there's a fair chunk of opportunity for consolidation in this market, in this country. And we think that's going to be very good for our unit holders going forwards as we get further institutional offshore money coming in to lock up more of the assets in this country. So we're well positioned for that. I'm now going to hand you back over to Brett, who's going to give you a bit of an overview of our Natgen UC22 trust and how we've been going there.
Thanks, Stephen. Yeah, so on the screen, you guys, you'll see a graph which shows the performance of the asset that was in the first initial couple of slides, Natgen Development Trust UC22. As I mentioned, it's complete. You can see it in the bottom right-hand corner and in its let-up phase. I'll start by just saying that these self-storage developments have a reasonably complex return profile, so I'm going to do my best to make it as clear as possible. But of course, if anyone has any questions, we're happy to answer them anytime. So as you can see on the screen, the blue line shows the development phase. In this project, we did initially expect that to be around 18 months, but we were subject to a delay from the council. I'll note that this block did not have a development application approval, which our PR25 block does. But in this one, we were subject to a delay with the council for the underlying subdivision. And those of you who live in Southeast Queensland will know that in the early part of 2024, we had about 3 months of rain at the start of our development. So that pushed it out to just under 3 years. But if you look at the end of the blue part, you'll see that we had an actual increase of our unit price of 70%. That far outperformed our initial expectations of about 16%. And we've recently entered the let-up period of this investment where the sheds are being leased. We leased up 2 or 3 today, and investors will shortly start receiving their monthly distributions, which will start small but will increase as we increase letting up the building. And then if you look at the end of the orange graph, our initial expectation was that the value would increase by about 43%, let's say, at the end of the let-up phase, and that's now looking at over 100%, closer to 110. So there's still a bit to let up there, but those returns are far better than what we expected them to be. And part of that was, the market has increased. A large part of that was our redesign of the building and being able to structure it to include a 1,500 square meter block on the second stage, which our unit holders will benefit greatly from. Again, understand that these are a lot more complex than just our standard existing property investment trust. So Steve and I and Caroline are happy to answer any questions relating to our PR25 trust and its return profile at any time. But there is also a lot of information in the information memorandum document, which we encourage you to read. Just before we wrap up, I thought it would be worth mentioning our self-storage brand, which we're very proud of, General Self Storage. On the screen, you can see Gary and Gavin, who are our current managers of the Coomera and Mollendina facilities. And we've had a few questions as to why we chose to do this instead of partnering with a national brand like Storage King and National Storage. And um, there are many reasons, but the first was obviously the fees that the national brands charge, which we've mandated a service agreement which with a lower management fee, so we can ensure that our trust net income is always as high as possible to benefit the investors. And then the second reason is uh, the agreements you have to sign with these national brands significantly hinder your ability to sell these assets. So running our own management business allows us to be flexible when it comes to disposing of them. We don't have any first right of refusals, which the bigger brands would enforce in those contracts. And then the third and arguably most important reason is the localized marketing strategy for filling these facilities up. So, for those of you who are not too privy on self-storage, it's a needs-based business. So people only use self-storage when they need it. They don't just stumble across it and think, oh, I'll get myself some self-storage. So marketing is an extremely important part of that business strategy, and having our own brand allows us to specifically focus on customers which are usually within a 15 to 20 kilometer radius that you would have seen in that previous graph Stephen showed with the purple around our site. And if you're tagged to a national brand, the majority of these guys make you contribute to a national marketing fund, which they can spend, anywhere in Australia. But with us, our marketing is spent directly in the position of where our customers are in that catchment, and uh, specifically targeting them is a huge benefit. And our let up period at Coomera, it's only been a bit over a month, but everyone keeps commenting on how well our marketing is. And I encourage anyone, if you go on the General Self Storage website, I can almost guarantee that the next time you go on Facebook or Google, you'll see our ads, and we're very proud of that fact because it's really reaping the benefits for how quickly we're starting to let up our Coomera facility and soon to be Mollendina facility. So back over to you, Caroline, to wrap us up. Thank you, everybody, again for joining.
Thank you. So with all Natgen investments, you do need to consider the information memorandum in its entirety, and please reach out if you don't have a copy of that already. Investment starts from 200,000 in this trust. We're currently at 80% subscribed. As Brett spoke to earlier, we have a portfolio of our existing building trusts where they provide monthly income, and then we also have a portfolio of development funds, which Stephen's just showing you there.
Sorry, I'll catch up in a minute, Caroline. Sorry about that.
That's okay. I'll go into a couple of questions we've had, and for those of you that joined the call late, just down the bottom of your screen, there's a Q&A button. So if there's anything you've thought about during the presentation that you'd like to ask, please put that in the chat now, and we'll have that answered for you. One of the questions that we have had come in, and Stephen's just going to show a video of the UC22 on the Gold Coast being built over the past 18 months. Brett, I might put this one through to you with regard to who we use for financiers through the construction part, and then when we then run the assets during their 5-year term.
Yep, no problem. Thanks, Caroline. Yeah, so with our existing assets, obviously those are all funded by the major banks. Our developments are a little bit different. We do get proposals from various banks, but we also get proposals for second tier lenders. And the reason we do this is the second tier lenders these days for developments of this kind, and with our little warehouses that we build, have a much more flexible funding strategy, and the rates are really not that different these days. There's so many second tier lenders out there that have huge mortgage books that are aggressively wanting to steal money away from the banks when it comes to loans. So in both of our previous self-storage facilities, they were provided by a second tier lender, and then the day we get our occupational certificate, they're actually refinanced through to CBA. CBA understands self-storage, we think, very well, and have provided us very, very very good funding for these two facilities during the let-up phase and then into the operational phase. So we have had a proposal we will get proposals from them. They are very interested in funding the development phase and the let-up phase. Whether we will use Commonwealth Bank to do that, we'll work that out closer to before we break ground. Very high chance we'll use a second tier and then CBA again from the let-up, but it really depends on the terms and how aggressive they all are on the industries at the time. So hopefully that answers your question, Caroline.
Thank you. Stephen, I might send this one your way with regard to how we choose builders for the sites and, how was the process controlling construction costs throughout the build of the last two facilities?
Sure. It's been one of the major achievements, I think, of the facility, the current builds, that we've kept the costs within our budget envelope for both the facilities that we've built so far, and that's been no easy feat, as you can imagine, over the last 2 to 3 years, given the massive increase in costs across the construction industries. So we do that by ensuring that we go through value engineering processes with our construction partners, and we're pretty careful who we choose to build our facilities to make sure that they've both got the wherewithal and the ability to undertake the construction, but also work with us to ensure that cost control is very important. But also making sure that we produce a really top quality product. And anyone on this call or any other of our investors, I urge you to come and have a look through either our Upper Coomera or our Mollendina facilities, because we're very proud of them. The quality of the builds are really excellent, and they are going to be mirrored in what we do at Park Ridge and future developments as well. Did I answer the question, or did I just
Yes.
totally step around it, Caroline?
I think you did. There's just one more question, which is just around divestment. I guess, where do you see, do you sell them on the open market, and who do you see being potential buyers for these?
Mm. Do you want me to take that one?
Sure, sure.
Okay, all right. So I alluded to this a little bit earlier when we were talking about the institutional investment in the market. The natural purchasers for these at the end of the term are probably the large institutional owners in this area. These are not the sort of facilities that are going to be sold one at a time, I would venture to suggest, although that's certainly possible. When we've got a portfolio of these, and Park Ridge will be the third, I think the best return on investment for the unit holders is going to be to have these packaged up and to sell them as a larger group to a larger, probably international group. The value of each facility will be determined independently and separately, but these groups are looking for scale. So the ability to provide them with scale gives us the opportunity to actually not only leverage the value of the individual properties themselves in which you're individually investing into, but the fact that there's a portfolio aspect to them, and that portfolio aspect will increase the value of each of them.
Yep, great. No? Well, that was all our questions for tonight, unless there's anyone last minute going to put one in. So thank you, everyone, for attending. Certainly email us with any questions you've got. If you'd like a copy of the presentation at all, we're here to help, and we appreciate your time this evening. And thank you, Brett and Stephen.
Thanks, everyone.
Carol.